Markets opened with a jolt as precious metals, long seen as a refuge, suddenly reversed course. What began as a historic rally in gold and silver came to an abrupt halt on Friday, sending shockwaves through global commodities markets and forcing investors to reassess the forces driving prices higher. Good evening. Here are the latest developments from the global commodities markets. Gold and silver prices fell sharply on Friday, marking a sudden pause in a powerful rally that had driven precious metals to record and multi-year highs earlier this year. Gold declined by 6%, dropping to around $5,000 per ounce. Silver recorded a steeper move, sliding 13% in a single session. The decline represented a significant reversal after months of sustained gains across the precious metals complex. The downturn unfolded alongside broader market turbulence. U.S. equity futures pointed lower, with major stock indexes set to open in negative territory following renewed selling pressure in technology shares. The simultaneous weakness across equities and metals underscored a volatile trading environment as investors reacted to rapid price movements across asset classes. By Friday, gold futures tracked under the ticker GC=F were trading near $5,000 per ounce after posting a 6% decline. Silver futures, listed as SI=F, fell by nearly 14%. The US dollar index, measured by DXY.NYB, edged higher by roughly 0.5%, adding to pressure on commodity prices during the session. This marked a notable shift from the strong upward momentum seen earlier in the year. Gold prices had risen by approximately 15% year-to-date prior to Friday's pullback. Silver had climbed even more sharply, gaining around 28% since the beginning of the year, following what was described as a stunning rally throughout 2025. The sharp moves on Friday effectively halted that advance, at least for the moment. Market observers pointed to heightened volatility as a key factor behind the sudden reversal. In comments published Friday, Mike McGlone, senior commodity strategist at Bloomberg, stated that historically, when metal prices rise to elevated levels, the likelihood increases that a lasting peak may be forming. He noted that based on historical patterns, the year 2026 could mark enduring price highs, particularly for silver. McGlone also emphasized that while rallies are often supported by solid fundamentals, extremely rapid price increases can lead to swift changes in market balances. Similar caution was expressed by Ole Hansen, head of commodity strategy at Saxo Bank. Speaking on Thursday, Hansen said that the ongoing surge across metals, especially gold and silver, was entering what he described as a dangerous phase. He highlighted the risk of volatility becoming self-reinforcing, explaining that as price swings grow larger, market liquidity can diminish, amplifying movements in either direction. The pullback came after a week of dramatic price action. Gold had surged past $5,500 per ounce on Wednesday. That move followed a decision by the Federal Reserve to hold interest rates steady. Commentary from Federal Reserve Chair Jerome Powell did little to reverse a decline in the US dollar at that time, which had been a supportive factor for gold prices. In a note published Thursday, before Friday's drop, Robin Brooks, senior fellow at the Brookings Institution, described the price action as a sign of strong conviction among investors betting on a weaker dollar. Brooks wrote that the dollar's softness was intensifying what he referred to as the debasement trade, contributing to higher precious metals prices. His comments were made prior to the sharp downturn seen at the end of the week. Gold's performance this year has been closely tied to movements in the U.S. currency. As the greenback eased against other major currencies, gold prices benefited, drawing increased interest from investors. Just 1 week earlier, analysts at Goldman Sachs had raised their year-end price target for gold to $5,400 per ounce. They also pointed to potential upside risks stemming from greater participation by private sector investors. At the time of Friday's decline, gold futures for February delivery were quoted at approximately $5,044 per ounce, down more than $300 on the day, representing a drop of nearly 6%. The price data reflected delayed quotes from the COMEX exchange and underscored the scale of the intraday movement. Silver's decline was equally striking. The metal had previously climbed above $120 per ounce before giving back some of those gains. By Friday, silver was trading at around $99 per ounce. Despite the sharp pullback, silver remained significantly higher on a year-to-date basis, reflecting the strength of its earlier rally. Analysts at JPMorgan, writing earlier this month, had cautioned that silver prices had already moved well above their forecasted averages. They also noted that identifying a market top is extremely difficult when prices are displaying near parabolic momentum. Those remarks took on added relevance as silver prices retreated sharply at the end of the week. Visuals from the global gold trade illustrated the continued activity in physical markets. On Thursday, a gold jeweler was photographed weighing gold bars for sale in Bangkok, Thailand. The image, provided by the Associated Press, captured ongoing demand and trading interest even as prices experienced heightened volatility. Friday's developments marked a turning point in what had been a powerful rally across precious metals. The abrupt shift highlighted the speed at which market conditions can change when prices reach elevated levels and volatility increases. While earlier gains were driven by currency movements and investor demand, the latest session demonstrated how quickly sentiment can reverse in a rapidly moving market. As the trading week came to a close, investors and analysts alike were reassessing the dynamics that had propelled gold and silver higher and the factors now contributing to increased price swings. The focus remained firmly on the data, official commentary, and market signals that have shaped the precious metals landscape so far this year. As we continue this report, attention turns to the sequence of market conditions and trading activity that set the stage for Friday's sharp reversal in precious metals. In the days leading up to the sell-off, gold and silver had been moving steadily higher, extending gains that had already accumulated over the course of the year. These advances unfolded against a backdrop of easing strength in the US dollar and heightened participation across commodity markets, factors that had supported the upward trend in metal prices. Gold entered the week trading well above levels seen at the start of the year. By midweek, the metal pushed decisively higher, surpassing the $5,500 per ounce mark. This move followed the Federal Reserve's decision to leave interest rates unchanged. Market participants closely watched the accompanying remarks from Federal Reserve Chair Jerome Powell. While the policy stance remained steady, Powell's comments did not interrupt the ongoing decline in the US dollar, which continued to weigh on the currency during that period. The weaker dollar played a significant role in gold's advance. As the greenback eased against other major currencies, dollar-denominated commodities such as gold became more attractive to holders of foreign currencies. This dynamic contributed to increased demand and helped propel prices higher earlier in the week. Gold's year-to-date gain reached roughly 15% before the downturn, reflecting sustained interest from investors seeking exposure to precious metals. Silver followed a similar path, though with greater intensity. The metal had already posted strong gains throughout 2025, described as a stunning rally, and that momentum carried into the current year. By the time prices peaked earlier in the week, silver had climbed above $120 per ounce. This represented a significant move, placing silver well above levels projected by some market forecasts. The rapid ascent in silver prices drew attention from analysts who had been monitoring the pace of the rally. Earlier in the month, analysts at JPMorgan observed that silver prices had already significantly exceeded their forecasted averages. They cautioned that markets exhibiting near parabolic price momentum make it extremely difficult to identify a definitive top. These comments highlighted the risks associated with sharp, sustained price increases, even as the rally continued at the time. While gold and silver were advancing, broader financial markets were showing signs of strain. Technology stocks, which have a significant influence on major U.S. equity indexes, came under renewed selling pressure. This weakness contributed to a wider stock market sell-off, with futures indicating that major averages were poised to open lower. The decline in equities coincided with increased volatility across other asset classes, including commodities. By Friday, the combination of elevated price levels and shifting market sentiment contributed to abrupt moves in precious metals. Gold futures fell 6%, bringing prices down to around $5,000 per ounce. The decline erased a substantial portion of the week's gains in a single session. Silver experienced an even sharper adjustment, tumbling 13% as traders reacted to the sudden change in momentum. The price action reflected what some analysts described as volatility feeding on itself. Ole Hansen of Saxo Bank had warned that as price swings intensify, liquidity can thin. Reduced liquidity can magnify market moves, leading to sharper rises or falls within short periods. His remarks, made a day before the sell-off, underscored the fragile balance present in fast-moving markets. Mike McGlone of Bloomberg also addressed the broader implications of the rally and subsequent reversal. In his commentary on Friday, he pointed to historical patterns suggesting that when metals reach elevated levels, the probability of forming lasting peaks increases. He specifically noted silver as a metal that could be particularly susceptible to this dynamic. McGlone emphasized that although rallies are often supported by fundamental factors, rapid price increases can cause market deficits and surpluses to shift quickly. At the same time, investor positioning and expectations were evolving. Just a week before the downturn, analysts at Goldman Sachs had set a year-end price target of $5,400 per ounce for gold. They also highlighted potential upside risks linked to increased participation from private sector investors. These assessments reflected optimism surrounding gold's prospects, even as prices were already near record highs. On Thursday, prior to the sell-off, Robin Brooks of the Brookings Institution offered his perspective on currency dynamics. Writing in a note, Brooks stated that the ongoing decline in the dollar signaled strong conviction among participants engaged in what he described as the dollar-down trade. He added that the weak dollar was intensifying the debasement trade, a theme that had been supporting higher gold prices. His comments were published before gold reversed course on Friday. As trading opened on Friday, sentiment shifted quickly. The US dollar index edged higher by nearly 0.5%, reversing some of its earlier weakness. This move placed additional pressure on precious metals, which often move inversely to the dollar. The strengthening currency, combined with profit-taking after the recent rally, contributed to the sharp declines observed during the session. By mid-morning, gold futures for February delivery were quoted at just over $5,040 per ounce, down more than $300 on the day. The nearly 6% drop represented one of the most significant single-day declines during the rally period. Silver prices followed suit, falling to around $99 per ounce after having topped $120 earlier. Despite the pullback, both metals remained higher on a year-to-date basis. Gold's gains for the year stood at approximately 15% before the drop, while silver was still up roughly 28%. These figures reflected the strength of the earlier advance, even as Friday's session underscored the volatility inherent in rapidly rising markets. The physical gold market continued to show activity during this period. Images from Bangkok, Thailand, showed a gold jeweler weighing gold bars for sale on Thursday. The Associated Press photograph highlighted ongoing transactions in physical gold, even as futures markets experienced heightened price swings. Taken together, the events of the week illustrated how quickly momentum can shift in commodity markets. Strong gains driven by currency movements and investor demand gave way to sharp reversals as volatility increased and broader market conditions changed. The sell-off did not occur in isolation, but alongside declines in equities and changes in currency markets, reinforcing the interconnected nature of global financial systems. As this report moves forward, the full scope of analyst commentary and market signals provides a clearer picture of a rally that surged on optimism and currency dynamics, only to stall abruptly under the weight of volatility and shifting sentiment. The week closed with precious metals at a crossroads, and market participants watching closely for what comes next. Stay informed by liking this report, sharing your thoughts in the comments, and subscribing for continued coverage of global market developments.